Hey everyone, welcome to the GrowVC Everyone Funding Startups podcast. I'm Brett Bivens. With me today is Lionel Slusny, co-founder of Loft FI. Lionel's an expert in capital and risk management, and he has extensive experience researching both the peer-to-peer and the crowdfunding markets. He's extremely well respected within the industry, and we are very, very pleased to have him with us. So Lionel, thank you so much for joining us today.
Thank you. Thanks for receiving me. Hello to everyone. So today we're going to talk about the impact of crowdfunding on traditional finance, right, Brett?
Yep. We'll be focusing on how, the emergence of crowdfunding has really, it's already started, but in the future it'll have even greater impact on the traditional finance sector and on banks. And, as the viewers can tell from the introduction, Lionel is, extremely qualified to discuss this. So before we dig into that, can you give us a little bit more background on yourself and about Loft FI?
Sure. So Loft Finance stands for bridging gaps between traditional finance and the crowdfunding community. We have been founded last year with a group of experts coming from the banking sector and the asset management sector, and we stand for helping crowdfunding platforms, crowdfunders, of course, and of course also the banks and the asset managers, the investment managers that would want to enter that field. And so far we have seen a tremendous growth in the past few years that is really leading all those players to use our services. So we are very pleased so far. Great.
Sounds exciting. So to get us started and kick us off, just to frame the discussion, can you maybe give us your definition of crowdfunding so that we kind of have that going forward?
Yes, indeed. If we stick to the very, let's say, narrow definition of crowdfunding being capital or equity raising for startups, crowdfunding has been, as I say, really a tool that has been increasingly used by startups. And we have seen a lot of growth, as I said already. Now, on the definition exactly, I think it's important for everyone to understand that in this podcast, we'll be focusing on crowdfunding being a capital and equity product by comparison to the debt product.
Right, yeah, and that should be a distinction that's made because banks traditionally are in the business of debt and not capital and equity, especially when it comes to early stage companies like many of the startups that we are discussing.
So, yeah, indeed. And actually, it's interesting to see that in the peer-to-peer finance space, it seems that there are a lot more, in fact, especially in these years, a lot more crowdfunding as capital or as equity products that are being brought to the market. And we don't really see at this stage debt financing models that are as innovative or, should I say, as much growing as in the capital space. Right,
and that has a little bit to do with the fact that many banks and the more traditional financial institutions, when looking to place debt, on a company, are looking for things like strong cash flow or strong asset quality, and a lot of startups don't necessarily have that at that time. So exactly. Right.
Yeah, indeed, I'm talking about the startup segments. I think that's the bulk of our audience today. So mostly you are looking for capital, you are looking for to raise equity or quasi-equity, I should say, and usually not turning to banks to do that. Of course, some banks might help you on for some debt financing or financing receivables or things like that. But at this stage, startups are mostly funded through equity.
Right.
Now, I think talking about the definitions, it's very important to see as well that at this stage, equity and capital raising is still done by actors that are much smaller than banks, and that to a certain extent can resemble more of the crowds. You have business angels, you have small institution investors, small VCs, private equitors. So all these people, all these actors are actually looking from far away as a crowd, in fact, and that's probably how startups would feel when they're trying to tap into that funding source.
Right, exactly, and things like angel networks and venture capital and private equity have been around for quite some time, and this, what we have now come to know as crowdfunding, whether that's the equity crowdfunding or whether that's a Kickstarter model or whatever it is a pretty nascent market, very new. A lot of people don't know a lot about it. And with that, there's a lot of kind of different ways that it could go. I mean, there's the possibility that crowdfunding doesn't necessarily take off and that, the traditional venture capital and angel networks win out. There's also the possibility that, crowdfunding takes off down the road and has to undergo some format adjustments. And then there's also the possibility, the thing that we all hope for, is that crowdfunding gains momentum in the short term, strong growth right off the bat. So
indeed, that's all the scenarios that I'm going to present. In fact, just to close on this introduction, how we're going to present this is actually go into the future scenarios and how crowdfunding may emerge in the few following years. And then look at really what are the implications for startups with this crowdfunding emergence, and then of course the implications for the banks. So with no further delay, on the question of will banks and traditional finance be influenced by crowdfunding, the answer is yes. Yeah, sure, it will influence banks and traditional finance. The question is in which way startups and managers and entrepreneurs will see their funders' relationship evolve in the few following years is the core of the question. Now, if we look at what are the bank's activities in capital raising, in fact, at this stage, I'm talking mostly for the European market that I know, of course, a bit better. Banks are not so active, of course, in capital raising.
Sure.
Yeah, they are nearly not existent. Of course, some investment banks do act as intermediaries for medium to large-sized companies through their specialized M&A arms. But at this stage, all I can say is that the traditional business of banks is, of course, debt and not capital or equity.
Right.
Yeah. So, having said that, I think if we look in the different scenarios in which crowdfunding will emerge, there are ways in which traditional finance and banks will really be impacted. So, if you just let me introduce what are the three scenarios I would like to share with you. First scenario is a scenario with, in fact, crowdfunding merely takes off. So being that the current incumbents and the current platforms, the current crowdfunding providers kind of continue to live but not to grow so much. Yeah?
Right, yeah, and that's...
So okay.
Yeah, that's something that I think a lot of the large financial institutions would like, to kind of partition these crowdfunding sources off as kind of a niche market.
Yeah, well, not so much, in fact. And I will come back into that. You might see some very traditional lists, I would say, players that might not want crowdfunding to emerge. But in fact, and that's my point, there might be an advantage for them in seeing crowdfunding platforms emerge.
Okay.
So let me come back to this first scenario. It's the first scenario where indeed the crowdfunding platforms are facing continued regulatory hurdles. There would be adverse selections on the platform, meaning that in fact on the platforms of crowdfunding, mostly bad investments or bad projects actually are being offered. Maybe the platforms don't reach the break-even, or there is a quick recombination of incumbents and the existing crowdfunding platforms. All this is a scenario where startups would not especially see an improved product offering from now. Now, where I agree, and I will come back on that, is that you already have sufficient enough different products and different platforms where you can actually find equity at this stage. Now,